Now here is our first story. One philosophy of investment expert Warren Buffett is to be fearful when others are greedy and greedy when others are fearful. This advice was ignored when Wall Street ran after the so-called creative financial products. Dreams of wealth have turned into a nightmare. A financial crisis which erupted in the US in August last year is now gripping the entire world. It's triggered a cascading series of bankruptcies, forced mergers and radical government interventions, and the end, as we see now, is nowhere in sight.
Another day begins in Wall Street's losing streak. Coordinated central bank rate cuts go into effect around the world a week after the massive bailout. Yet fears of recession are as strong as ever.
I think the market is totally confused about not only all these measures going on, but I think there's a lot of uncertainty about what other problems there are that haven't been quantified yet.
On Monday the 29th, the U.S. Treasury proposed the bailout Emergency Economic Stabilization Act to the House. Under the plan, the Treasury Department would be authorized to purchase up to $700 billion of broken mortgage-backed securities. The House passed the bill by a comfortable margin a week ago Friday with modifications, and President Bush quickly signed it into law. But the bill leaves unanswered precisely how the Treasury will price and purchase the assets and manage them, questions that will decide whether the plan works.
It's going to take a while to restore confidence in the financial system. But one thing people can be certain of is that the bill I signed is a big step toward solving this problem.
Under free market conditions, Federal Reserve Chairman Ben Bernanke said government assistance should be provided only when the financial system and thus the health of the broader economy are at risk. In those cases when financial stability is threatened, however, intervention to protect the public interest may well be justified. Back in March, the Federal Reserve supported J.P. Morgan Chase's offer to buy beleaguered Bear Stearns with $30 billion special financing. And last month, the U.S. government acted aggressively in taking over the struggling Fannie Mae and Freddie Mac.
Some say if you just allow it to happen, then people will be more cautious next time and the markets will work. I don't think politically, or even the smartest people that I hear, Secretary of the Treasury and the financial officers of other countries, I think they believe that intervention is necessary and therefore more regulation is necessary.
The U.S. Labor Department reports that American employers eliminated 159,000 non-farm jobs last month, the fastest pace in 5 years. There are 497,000 Americans out of work in a weak labor market. The unemployment rate stayed at 6.1% after a steep climb in August.
We find that when the banking system suffers major damage, as in the current episode, the likelihood of a severe and protracted downturn in activity increases.
Analysts say the real economy will feel the pinch of the credit crisis.
It means that small and medium businesses, those are the ones that are squeezed the hardest by a credit crunch. They are the drivers of growth in the economy. They provide the opportunities, the jobs. If they're cut off, then we're going to see a much higher rate of unemployment and basically the real economy going into deep recession.
The financial storm on Wall Street and the credit crunch couldn't come at a worse time for consumers and retailers just ahead of the holiday shopping season.
The housing crisis at the very heart of the turmoil has yet to reach its peak. The International Monetary Fund warns that U.S. financial sector losses could total $1.4 trillion. Now the crisis is spreading in two directions, out of the financial markets into the real economy and across the oceans to the rest of the world.
The crisis is intensifying in Europe. According to The Economist, in America, outside Wall Street, the banks have lent 96 cents for each dollar of deposits. Continental European banks have lent roughly 1.4 euros for each euro of deposits. They have to borrow the rest from money market investors. And some European banks must contend with the American securities they bought for the billions, as well as their own slowing economies. European governments have been forced to prop up 5 banks in 7 countries in the last month. And last weekend, leaders of Germany, France, Britain and Italy pledged in Paris to take all steps needed to ensure the stability of the financial system and to coordinate as necessary.
All players in the financial markets must be regulated and supervised, not just commercial banks. Secondly, prudential rules must be revised in order to prevent liquidity crisis as now, when the outlook is worse.
On Wednesday, the US Federal Reserve and other major European central banks moved in concert to slash key interest rates. China, Canada, Sweden and Switzerland followed suit. The Bank of Japan said it strongly supported the actions.
To limit the fallout on the real economy, it is therefore of paramount importance that the damage to the banking systems in the United States and Europe be swiftly contained by far-reaching and comprehensive measures. This lesson is clearly brought out by the experience of many economies that have struggled with virulent financial crises over the past decades.
Asian countries are export-oriented economies. Analysts say when there is a world market slowdown or recession, Asia usually gets hit the most. To prevent the spillover of the US crisis, China, South Korea, Japan and ASEAN countries may speed up the creation of an $80 billion fund to safeguard regional financial stability.
And for Asian countries, the most important is setting our own policy to avoid or to mitigate of those impacts. Asian country had experienced the Asian crisis 10 years ago and probably better prepared compared with other regions.
As uncertainties increase in the global market, China is expected to contribute a turnaround. The country continues to have double-digit growth rate. It grew 10% year-on-year in the second quarter, making it one of the rare bright spots in the global economy. Last week, Premier Wen Jiabao expressed his view during an inspection in the Guangxi Zhuang Autonomous Region in South China. It will be the biggest contribution to the world for a huge country with 1.3 billion people to maintain steady and fast growth in the long term.
If the Chinese economy is stable, and they will show to the other countries, particularly to developing countries, if you have a good policy response, it's possible can avoid or can minimize of those shock impact.
To minimize the impact of the US financial crisis, China said it would strengthen prudent supervision of its banks and ask them to enhance their own risk management. And the central bank cut benchmark lending rates last month for the first time in 6 years. Many saw the cut as a turning point in the country's monetary policy, with Beijing shifting its focus to supporting growth from battling inflation. On September the 27th, many business elites and economists at the summer Davos in Tianjin expressed optimism on the Chinese economic outlook.
I think this financial crisis and economic crisis made China from looking always outside to look inside. China, the future for China is the domestic demand.
As I have said, confidence at this moment is more precious than gold or any currency. One more thing, I believe China can achieve this. It means China can keep its economy strong, stable and growing at a relatively fast pace without major fluctuations. This will be China's vital contribution to the world economy.
Economists point out that though emerging economies have seen their exports affected by the US economic slowdown, their domestic infrastructure still has much room for improvement. This could be translated into huge development potential.
A chilly winter is right around the corner. The snowball in the financial market isn't likely to melt this season. To quote the late Winston Churchill, now this is not the end, it is not even the beginning of the end, but it is perhaps the end of the beginning. For people inside and outside Wall Street, overall collaborating might be the best way to get warm.